talk about step 3, which is developing a business succession plan. And this is something when you think about estate planning, it's easy to sort of lump this in with everything else and just think about who am I leaving the assets to. But separately, you really need to think about what you need to do to set the business up to keep functioning successfully as it transfers to the next generation. So this one does have some to do with ownership, but also just about operation as well. And I think if we pull this piece out and really focus on the business operation aspects, it can be really important to help ensure that successful transition. So I have a slide here that says, what would Steve Jobs do? And the answer is Steve Jobs would not just wait till somebody died, put in his will who's going to run Apple and hope for the best, right? And unfortunately, that's what a lot of farmers and ranchers do with the operation of their business. And you have to think about it. It's, because our personal life and our family life and our farm life is so interconnected, it's easy not to think about that as a business. But we're talking about a business generally with multi-million dollars worth of assets. We've got to have a plan for succession and who's going to do what tasks to keep that business running when someone passes away. So I want to talk about what I call the 3 mice scenarios. Do you guys remember that kid's book called Country Mouse, City Mouse? Right? My kids love that. I think there's some estate planning wisdom in there. So what I want to talk about here is I think that there are kind of 3 different scenarios that a lot of farm families find themselves in when it comes to identifying who the potential heirs are and how this may work in the future. And the point I want to leave you with on this slide is it doesn't matter what your scenario is, there are potential issues that you've got to deal with for all of them. So let's look at what I call the 3 mice scenarios. The first scenario is going to be the country mouse, city mouse scenario. That's the on-farm kid and an off-farm kid, like our song we listened to earlier. Likely, if you've got an on-farm kid and an off-farm kid, they may have very different values and economic perspectives about that operation. Right? And so you'll see that sometimes with, do we need to sell the land and just take the money? If anybody watches Yellowstone, right? We got the Beth scenario where Beth's always like, let's sell this place. We can get rich. We're going to lose it all anyway. Then you've got somebody like the brother Lee that died in the first episode, right? He was in it to be on the ranch. That's what he wanted. Different values and perspectives. A lot of times this is where that issue of sweat equity comes into play. How do we value the contribution that the on-farm kid has made all those years when we're looking at how to leave this operation? Do we want to leave it equal shares to every kid regardless of the kind of sweat equity contributions that they've made? Maybe we do. I'm not saying that that's wrong. Or do we want to try and look at that equal versus equitable line from the song and figure out, do we need to be compensating the on-farm kid differently than the off-farm kid, right? These are just, again, issues you need to think about, discussions that you need to have. Because without an estate plan, I really think that the city mouse, country mouse scenario is the one that's most likely to end in a disaster. The second scenario let's look at is the country mouse story. This is my own family scenario where you've got 2 kids that would love to end up back at the farm. Right? And for some people, they're thinking, well, wow, that's the dream, right? All the kids want to come home. Well, there's issues there too, right? Can the farm generate enough income to support those 2 families? We better do some real math and try to figure that out, right? If, the kids that want to come home, if they've got spouses with jobs in other towns, is it going to be feasible for that family to move back to the farm and be able to afford to live there? We have to think about those kind of things. Can the 2 of them make decisions together, right? I say all the time, I love my brother. Neither of us want to be on each other's checking accounts, right? We better think about that before we're all of a sudden, bam, here's a farm, okay? Who's going to handle the daily operations, okay? And can they get along in doing so? Because sometimes you can see some resentment if one person wants to come in and run everything and the other one feels left out. On the flip, you may see some resentment if one person is running everything and the other one's not doing anything, right? So there's a lot of conversations that you really need to be able to have in that space. Right? Another thing I will tell you here is sometimes you'll hear people say, well, we're going to just leave it to the kids together because then they'll have to, work together and have to work it out. The worst thing you can do for two people who don't get along is shove them into owning property and running a business together. You're setting them up for failure when you do that, and that's something that I think you really need to think about. There's another podcast episode that I did that might be interesting to listen to. It's with Shannon Farrell, who's a kind of in a similar role to mine at Oklahoma State University. And they ran some simulations looking at the potential success for a farm transition if you just leave all the land to two kids jointly. The results were pretty staggering, and essentially that almost never works out from a mathematical standpoint, again, especially if one has to buy out the other or different details. So that's an interesting podcast. We'll make sure and get a link to that here where you can listen to it if you're interested in that topic. So, and again, because of that, one decision you have to make here is how are you going to leave it, right? Are you going to leave it to both kids as joint owners? Are you going to divide it? Like we talked about before, if we divide it, how? And can they both make it if you divide it? Are you going to sell it and give them money to both go buy their own place? Again, lots of things you have to think about there. The final scenario is one that I think maybe a lot of farmers would tell you might be they would feel like will be the hardest or the worst scenario, and that's if you've got a city mouse situation, right, where your kids have left home and nobody wants to come back and operate the farm. Unfortunately, right, that may be a situation that you're facing, and it happens for a lot of people. You got to figure out what you're going to do with the farm in that scenario, right? Are we going to keep it? Are we going to lease it out? Do we want to sell it? Right? There's going to be some decisions that have to be made there if you don't have somebody, an heir identified to come home, right? So on the leasing front, one thing I would really encourage you there, if that's something that you're thinking about, well, we'll leave the land to the kids and they can lease it to somebody. You may want to be involved in negotiating that lease because you've got the knowledge to do it, right? And the kids who maybe live in, Dallas or New York wouldn't have that. And to make sure they don't get taken advantage of, you may want to help ahead of time with drafting a long-term lease or identifying the tenant that they would need to contact. So that's something to think about as well. If you're going to continue, you're going to have to figure out who's going to be in charge of the daily operations. And again, if nobody lives there, it may need to be a tenant. It may need to be, if there's some sort of hunting operation. I've seen people that the kids really want to keep the land in the family, but they aren't going to move home and run cows. Maybe you lease it out for hunting, and then the kids can come out in the summer and fish in the lake or whatever it is. You just got to think about that and really think about how to best set that up. Then another situation there is if you decide you are going to sell the farm, again, there are some implications there, especially when we look at capital gains taxes. Make sure you talk with your accountant before you do that to see if there may be better ways to go about the timing of that type of sale. So a few considerations, again, when we're talking about business succession planning, who's going to be involved, right? And there are different levels of involvement for any farm. So who's going to be there, like day-to-day operations, basic decisions, right? Who is running the tractor? Who is running the grain cart at harvest? We've got to have people on the ground doing that work. Who's going to be involved in functions like accounting, right? Maybe we've got, sister who lives in town, but she's great with the books. Maybe she can run the books. All right, so think about that. Who may need to be involved in real strategic decisions, like are we going to sell or not? Or should we be leasing something, or should we be looking for other income opportunities? Maybe there's people that should be looped in there that aren't necessarily in the day-to-day. Who maybe just has a financial stake in it? You really need to identify who all is going to be involved and kind of what level of involvement they're looking at. How are new roles going to be created or existing roles be changed? That was one that's really important, I think. And I look at our own family, and my dad has run that farm since he was 14 years old, right? He does everything. When he dies, my brother and I, neither one of us can fill those shoes. And so we better be figuring out who are we going to need to bring in to help with some of this for the pieces that we maybe don't know well. What type of training or experience or education does that next generation need? And that may be in the formal setting. Maybe you need to be sending somebody to, a program like Master Marketer, or maybe somebody needs to be going to college and getting a, agronomy degree or whatever that might be. that may also be you need to be pulling somebody in here and letting them help you and see what you do, right? We kind of came across this when the 2014 Farm Bill was passed. You know, I work at Texas A&M. They had that decision aid to help us decide, do we want to update our base acres? Do we want to pick ARC or PLC? And so I told my dad, hey, I'll run the stuff for you. I'll spit out the answer. And that's when I realized I did not know crap about our operation at the FSA office, right? I didn't know our farm numbers. I couldn't even get started on trying to figure any of this out. And so that led to a pretty good come to Jesus talk with our family that basically was like, look, you can't die and take all of the knowledge with you because we will fail, right? You have to share this with us now where we can learn it. So, for example, now when we're doing stuff at the FSA office, right? I'm involved. I'm talking about what decisions he's making, why he's making them. How come you're choosing that insurance over this insurance, right? Why are we picking this 2-month interval on PRF and not the others? So that's really been good, and I think a good example of you've got to loop people in, because the worst thing you can do is take the knowledge that you have to the grave with you and leave everybody else behind scratching their heads because they just don't know. Is the founding generation willing to release some control? That one can be interesting, right? Is, grandpa, retired farmer, gonna let son start making some decisions? Is he gonna get to choose what seed to plant or how much water to put or whatever? Maybe the answer is no. And I'm not telling you that's right or wrong again, but from the grandpa perspective, do you want to let them and kind of see if they can sink or swim while you're still here to throw them the buoy and help them with stuff? It's something that you may need to be thinking about. The next thing I want to talk about is, would a business entity be beneficial? So when we talk about business entities, there are a lot of pros and cons outside just the estate planning or business succession planning conversation that you need to be aware of. And again, I hate to keep doing this to you, but this is not a one-size-fits-all thing. There's no magic. I wish I could tell you that every corn farmer in Texas needs an LLC. That would be easy. I can't tell you that, right? Because so much of this is fact-specific depending on a number of situations in your own operation. So what I think we'll do instead is kind of walk through some of the more common business entities. I'm going to try to kind of give you the highlights about what they are, some things to look for, and hopefully that will allow you to go have a conversation with people that can help you make those decisions. The people you need involved there is an attorney. I think it would be certainly helpful to look at some of it and to help you draft up the documents. Maybe more important, your accountant, because there can be some real tax implications here depending on how you set these up, as far as what you have to file, what the tax rate is, what you're paying for the accountant, etc. So keep that in mind. So let's look at these different entities that are kind of common. Here are the kind of the 5 that I want to talk through. The first one's a sole proprietorship, and that's what you have if you don't have a business entity, right? Then you've got a joint or general partnership, which you'll sometimes see called a joint venture. Then we'll talk about limited partnerships, LLCs, and corporations. So let's start with the sole proprietorship. Like I say, this is the simplest. It's kind of the default form of a business, right? If you're somebody who doesn't create a business entity and you're not working with somebody else, you're a sole proprietorship, all right? The pros of that, right? The benefits of being a sole proprietorship, it's automatic. You don't have to file any paperwork with any office. You don't have to pay any fees. You just basically say, bam, I'm a business, and we're up and running. There's no formal creation requirements. There's no added paperwork, right? You don't have to draft up any sort of operating agreements, or you don't even file separate tax returns. It's just something on your own taxes. There's a lot of flexibility there, right? Because there's no rules. You're going to make it up as you go. It also offers pass-through taxation, right? And that's because there's not a business entity to be taxed at. You're taxed at your own rate. Let's look at some of the cons or the downsides of a sole proprietorship. One of the biggest ones a lawyer is going to tell you is there's no limited liability, right? So if something happens and the company gets sued, right, the business gets sued, they can come after your personal assets because you and the business are one and the same, okay? And that can be a really big deal, especially if you start having like employees where you see this really come up, from kind of a tort context is, let's say that you've got an employee who's got a custom harvest business. You've got it in your name. Your employee's driving up and down the roads. Dangerous to have a combine on the highway, right? Gets in an accident, they can come after your personal assets, right? Because you are the business. In Texas, if you have no physical business presence, like if there's not a, brick and mortar presence, you've got to file what's called a DBA in each county where the business is conducted. So there is at least a little bit of paperwork there. There's no built-in estate or transfer plan for a sole proprietorship, right? Like when we talk about an LLC, for example, you got an operating agreement that probably is going to spell out exactly what happens if somebody dies or how, shares can be bought back or whatever. They don't have that for a sole proprietorship, so that's just sort of not built in. The other thing is, for a sole proprietorship, any income that you make is subject to self-employment taxes. And so depending on the tax rate that you're at, and the corporate tax rate at the time, that could be beneficial or not to you from a tax standpoint. So that's sole proprietorship. The next one let's talk about is a general partnership. In Texas, that's defined as two or more persons associating to carry on a business for profit. Where this gets interesting is you can accidentally be a partnership, okay? So if you have two or more people who are working together for a business for profit, that's a partnership. I don't care if they intended to be one. I don't care. You don't have to file anything with the state. You just, bam, you could be a partnership. So be aware of that. The advantages of a partnership. There are no formal creation or filing requirements. Now, I will tell you this. If you are in a partnership, I highly, highly recommend you have a partnership agreement, right, to spell out the rights, the obligations, those sorts of things. There's no requirement that you do so. It doesn't require consent from all the members to make a decision. That can be good or bad, but when you're looking at that, essentially one partner can bind the partnership, right? You don't have to go through, like a corporation, you may have to have a vote of so many people to take action. That would be an issue here. This one could be a big deal for the ag audience. If you have a general partnership, each partner is eligible for a USDA program payment. So, for example, all right, let's say we've got husband and wife both actively engaged in farming. There's two people in that partnership, right? Program payment limit $125,000. Husband gets $125,000, wife gets $125,000. The partnership has $250,000 total because you got two limits. That's not the same for some of the other entities we're going to talk about. And I'm just going to tell you, if you see people who are in a general partnership and you have talked to lawyers and been to the lawyer and drafted up a partnership agreement and are really doing things right, a lot of the time the reason for it is the program payment limits, because they want to qualify for those multiple payment limits. If Congress could get that fixed, that would be awesome. But I don't have that kind of pull to make that happen. But that's an issue that you want to be aware of. As far as taxes go, the taxes pass through to the partner. So it's a pass-through entity. There's no taxation at the partnership level. But the entity may need to file a tax return. Again, visit with your accountant about that if you need to file a partnership tax return. Downsides to a partnership. You might accidentally create one. We talked about that earlier, right? If you're carrying on a business for profit with somebody else, you could accidentally be a partnership. And the reason that's a problem, number one, partners can bind the partnership, right? So if your buddy goes out and commits you to some contract that you don't know anything about, he has the authority to bind the partnership, and now you're on the hook, okay? Also, partnerships partners are jointly and severally liable for the debts of the partnership, which again means, right, if you've got your buddy and he goes out and runs up a huge bill at the co-op, they can come after him, but if you're partners, they can also come after you to get that paid. So that can be a real issue. There's no limited liability for the members of a general partnership. So again, that's a benefit of some of these other entities. General partnerships, no limited liability. The next one is sort of the default rule under Texas law is that profits and losses of a partnership are shared equally regardless of input. So what that means, let's say we decide to start up a partnership and I put in $100,000, right? And Angie puts in $25. If we start up the partnership and we don't agree otherwise in a partnership agreement, profits and losses are split equally regardless of what we put in. So that can be a real issue. And again, why having a good partnership agreement can be really important. Same here, if you don't have a physical business presence, you need to file a DBA in each county where you're conducting business. All right, let's talk now about a limited partnership. And sometimes you'll hear these called family limited partnerships, same concept, but in FLP, it's only family members that can be part of it. A limited partnership is just a partnership arrangement where there is at least one general partner and at least one limited partner. All right? Where this particularly seems like it could be a good fit to me is if you've got an on-farm air, off-farm air operation, right? But let me explain to you sort of why it may fit there. The advantages of a limited partnership are, there's several things. The first one is limited partners are going to get limited liability. So the limited partners won't be liable for the debts of the limited partnership, right? So again, let's say we've got on-farm kid driving tractor has an accident. If off-farm kid, the limited partner, her assets are protected, okay, because of that limited liability. Now, in exchange for that limited liability, that limited partner cannot be in charge of like day-to-day operational decisions. Okay, so that's a limitation there. The general partner is the flip. The general partner is the one in charge of the day-to-day operations, but they do not have any limited liability. Okay, so keep that in mind. There's pros and cons, I think, to both of those. There's some flexibility in how you organize this. There are different rights you can kind of give people. It is taxed as a pass-through entity like the others that we've talked about. Some of the downsides. The general partner has no limited liability, and they're going to owe some duties to the limited partners, right? Kind of fiduciary type duties. You've got to take care of the best interest of the partnership. The limited partner cannot have control of the business, and so that's a limitation they have to recognize, or else they'll lose that limited liability that this affords them. There are formal creation requirements. You're going to have to file certain paperwork with the Secretary of State's office. You're going to have to pay a filing fee. Again, hopefully you're going to have a limited partnership agreement that really spells everything out. And the other downside here, of course, is the farm program payment considerations, and it may be limited there as far as limited partnerships go. So that's just another option there. Let's talk next about limited liability companies, or LLCs. There's a class in law school that you take called Business Associations where they walk through all of these. I remember very little from that class except for on the day we did LLCs, my professor showed up wearing a suit jacket on top and sweatpants on the bottom. And he said that that's what an LLC is. Like, it's got some of the formal and some of the like party on bottom. So LLCs, that's how you can think of those. Maybe you can remember that. These are a little bit of a combination of a partnership and a corporation, okay? And they were created fairly recently, within the last 50 years or so. They became really popular because of some of the benefits that they can offer. So the setup for an LLC is you create this separate entity, right, the limited liability company, and it's owned by members. So you've got members of the LLC, and there's a lot of flexibility on how you can set that up. It can be managed either by a member, so it could be a member-managed LLC, or it can be a manager-managed LLC where you kind of hire a manager to do that. The benefits, like I say, really flexible. It's got limited liability. So if you're a member of that LLC, you're not liable for the acts of the other members, right? That can be really important. In general, again, unless you provide to the contrary in your operating agreement, profits and losses are shared in proportion to ownership interest. So that's going to be really different than the partnership, right? So like I said earlier, if I put in $100,000 and Angie puts in $25,000, in the partnership, we're 50-50. In the LLC, we're not. And I'm not good enough at math to give you the percentage that we would be, but I would have a lot more than Angie would, all right? You can elect, as far as tax goes, this is interesting. You can choose for your LLC to be taxed as a partnership, where you get that pass-through taxation, or you can choose for it to be taxed as a corporation. And again, that's a decision you're going to want to make with your attorney, but there's some flexibility there to make that choice. And you can sort of use this as a built-in succession plan. Again, you can talk about who has what percentage interest, who has the right to own an interest in that, what happens when someone dies. Maybe their interest automatically passes to the other members. Maybe there's a buyback provision. So you can sort of use this as part of the business succession planning tools if you use an LLC. Just like with everything else, there's some downsides. There are formal creation requirements to the LLC. You're going to have to file an operating agreement with the Secretary of State. You're going to have to pay the fees that are related to having to do that. There's going to be separate financial management that's required. What that means is you're going to have a separate checking account. You can't roll this all into your account and just say, oh, I created this LLC, but then I acted like I didn't. If you do that, especially from a liability perspective, you can really get in trouble. And a court may allow someone to do what's called piercing the corporate veil. Essentially, it means if you don't treat this like it's a separate entity, we're not either. And you could go ahead and have that personal liability if you don't sort of jump through the right hoops. So that's something to be aware of. Again, farm program payment considerations. Let's say that we've got 5 members of the LLC. All of them are actively engaged in farming. If they were a partnership, all 5 of them could get that program payment limit. Because this is one LLC, there's only one. And again, this is where there are some operations that are big enough, that are getting enough of those payments that they just can't afford to become an LLC, despite the benefits they would get, right? Maybe they would feel so much better about the liability. I know one operation that basically said, look, we'd love to have limited liability. We can't afford to do that because of the payment limit. We're going to take some of that extra payment money we get and we're going to buy more insurance to just over-insure ourselves and hope that liability won't be an issue. So that's something to keep in mind when you're thinking about an LLC. Okay, the last one we're going to talk about is a corporation. This is the most formal. It's kind of the fanciest of the options that you've got. The advantages of a corporation, you get limited liability. So just like with the other, LLCs, the limited partner in a limited partnership, you're not liable for the obligations of the corporation. That's a good deal. There can be some centralization of management, right? A corporation generally is going to be owned by stockholders or shareholders. You're going to, in the operating agreement, spell out exactly who's got what rights, who makes what decisions, who manages. So it kind of forces you to spell that out in the agreement. You can have that built-in succession plan. Potential benefit, at least right now of corporations, is there's a 21% corporate tax rate across the board. And so if you're a corporation right now, your tax rate is 21%. Now you get taxed right at that corporate level. So sometimes we talk about, pass-through taxation is actually better. Well, maybe not depending on your tax bracket, right? Because if I get taxed at 35%, but the corporation would get taxed at 21%, maybe I'm better off there. So again, lots of issues there to think about, but at least right now, that lower corporate tax rate may be a benefit. Let's talk about some of the downsides of corporations. The first one is they're the most formal. And so there are formal creation requirements. Again, you're going to have to file paperwork at the Secretary of State office. You're going to have to pay the fees to do that. They're also the most difficult as far as maintenance goes. There's going to be more hoops that you have to jump through. Corporate tax returns are going to have to be filed. You're going to have to make sure you follow everything that's in your documents that tell you kind of what you have to do. So they're the most complicated from that end. Again, as we've talked about multiple times, there's the farm program payment limitation issue that applies to corporations as well. As far as if you've created a C corporation, there can be issues that make it particularly difficult if the C corporation owns land. And that has to do with difficulty of getting the land out of a C corporation once it's put in there. There can also be some step up and basis issues that come into play there. So be aware of that. The other downside to a corporation is that there can be double taxation. And so that's where when money comes into the corporation, it's taxed at the corporate level, right? That 21% corporate tax we talked about. But then if the corporation pays dividends out to the shareholders, that's also taxed as income for the shareholders. So we're really seeing a double tax there. Now, one way you can avoid that is if you do create an S corporation. And what that is just a special kind of corporation that allows you to avoid the double taxation. Now, there's some requirements you have to meet for that. I think in general, most farming operations would meet those. It's things like you got to have less than 100 shareholders. There can only be one class of stock, some things there. So again, if you're interested in setting up a corporation, I'd really check with your accountant to determine if you're better off using a corporation at all, and then make sure you have the C Corp versus S Corp conversation.